What we're going to be going over here is post-retirement benefits accounting, and this is where you're going to have similar entries here as for pension accounting. You're going to use a similar worksheet here in the accounts. Now, what you have to do is you have to maintain separate accounts for the post-retirement benefits here and your pension accounting. And we're going to go through an example here where I actually did the example for pension accounting here, but we're going to look at it in terms of the post-retirement accounts. All right, so let's go through it here. And the other thing is here, if you're really looking at trying to determine problems here for the post-retirement benefits accounting, you can actually reference pension accounting to determine what your journal entries would be here. Okay, so let's go look at our example here, and we're going to look at it from the post-retirement worksheet format or the pension worksheet format. Okay, so what we're going to be going through here is really 7 different accounts here, but we're going to start out with what I had labeled here as pension expense, but now we would relabel that as post-retirement expense here, and this would be the annual expense. And just looking at our example here, I've got it in thousands of dollars here, but I also have it referenced ABC here, letters here behind each one of these numbers here, and that you can use as a reference for your debits and credits, the matching debits and credits. So when you're dealing with your post-retirement expense, it would be the same as items here as pension expense. You're going to have some service cost, you're going to have some interest cost, and then you're going to have gains or losses on the investment here, or the expected return on the investments, and then you're going to also amortize some prior service costs. So just in our example here, we're going to have some service cost, debit for $90,000, interest cost $70,000, and then we're going to have to deal with our expected return on our plan assets here versus the actual return. Now, in this case, I'm just pointing out here that we have an unexpected gain here on the return of their plan assets. Now, the expected return was to be $44,000, but our actual return here was $64,000. So going over to our pension expense, we would credit it or reduce our pension expense for the actual return that we had here of $64,000. Now, to balance out, we would have an unexpected gain here, because looking at our expected return, we expected only $44,000. Our actual return was $64,000, so we have an unexpected gain of $20,000 here. Really, what you just have to do is look at the difference between your expected return and your actual return to determine if you're going to have any unexpected gain or loss. So in the case here, we're going to have an unexpected gain of $20,000. So here we actually increase our pension expense for the $20,000, and you'll see why we do that here when we record it in the other comprehensive income. So in essence here, our expected return balances out to $44,000. We have pension expense. We reduced it for the actual return here is $64,000, and then we debited our unexpected gain here for $20,000. And then finally, for pension expense, we're going to have, in this case, $10,000 here for the amortization of the prior service costs for the year. So netting our debits with our credits here, we're going to come up with pension expense here for the year of $126,000 or 126. Everything is shown in thousands of dollars here, and that's what we're going to be using when we record our journal entries here. Okay, so we looked at our expense here. That's the annual expense, and really we're looking at the post-retirement expense. It would have the same elements as our pension expense. So those you can cross-reference between your pension expense here and your post-retirement to determine what elements are included here in your annual expense. Okay, so then moving over to I have shown here pension contribution. Well, actually that could be post-retirement contributions, and that's our cash account here on our balance sheet. Now remember, our pension expense was gone to the income statement here. And the cash account, of course, on our balance sheet here, this is where we're going to have a contribution, a contribution to the post-retirement plan here. So what we would do is we'd credit our cash account, or reduce it in this case by $105,000. So that's the cash that we contributed to the post-retirement plan for the year here. So for year X1, we would credit or reduce our cash here for $105,000. Okay, so now this is where we move over to our other comprehensive income, and now we have to break it out here for the post-retirement elements here. And the other comprehensive income, this is an equity account here on the balance sheet here. So what we have to do is we have to break out our other comprehensive income, our OCI, between our prior service cost and and other comprehensive income for any gains or losses here. Again, equity account on our balance sheet here. So in our example here, we're going to have, looking for our prior service cost here, that's where we, again, for other comprehensive income for the post-retirement here, we have that amortization of the prior service cost of $10,000 here. Debit, increased our pension expense for $10,000. So now what we're going to do is we're going to credit or increase our other comprehensive income here for $10,000. So for our prior service cost for the year here, we just had a credit or an increase here of $10,000. Now, just say, for example, here, our beginning of the year, we had a balance sitting here at a negative balance or a debit balance in our other comprehensive income for $150,000. So the end of the year balance sitting in our other comprehensive income for the prior service cost is just the net difference here. $150,000 debit reduced by the $10,000 credit here. So our end of the year balance is $140,000. Okay, so now we've taken care of our prior service costs. And that was for the post-retirement prior service cost. Now, we move over here to gains and losses here. So we've got several of those that we're going to look at, and how it affects our other comprehensive income. Now remember, gains and losses have to be separated out here in a separate account here, under other comprehensive income. So we had the unexpected gain on the return of assets. That's the first thing we're going to look at here. And that was a credit, or we had increased our pension expense for $20,000, but here's the case where the credit goes to other comprehensive income here for $20,000. Okay, so that was that unexpected return on our planned assets. Now we're also going to have another reduction here, or it's going to be a change in estimate here to the projected benefit obligation in this case on these post-retirement here, and we'll get into that number here. But first off, let's go and let's look at our post-retirement, and I'm showing pension asset and liability, but in this case we would have it down here for the post-retirement asset and liability, and that's what we're going to have to determine what the change between our asset and our liability here is on this post-retirement plan for the year here. So what we're going to do is we have to start out with our beginning balance for the year here, and we're going to determine that to be $60,000, or credit or reduce our pension asset by $60,000. So how we got that is we go up here, and we're going to have to set up for the pension. We had a projected benefit obligation, but when you're dealing with your post-retirement account, you call it the accumulated post-retirement benefit obligation. So dealing with post-retirement, label it as such here. And then we also have our plan assets. The asset account here, that's for our post-retirement plan here. And just back here for the projected benefit obligation, this is the liability account. And these are memo accounts here. We're not going to include them in our journal entries. These are memo accounts where we keep track of the liability here for the post-retirement plan, and also our assets here for the post-retirement plan. So looking at how we're going to start out with determine if we got a pension asset or liability here. So we have to start out with our post-retirement benefit obligation here. We have to determine what the beginning of the year balance is here for year X1. So we had a credit here of $700,000, and then our post-retirement plan assets, we had a debit amount here of $640,000. It's fair value. That's the beginning of the year here. So the difference here is going to give us a post-retirement reduction in our post-retirement asset account here, or an increase of the liability by $60,000. So you just make the comparison here. You look at the accumulated post-retirement obligation. If it's less than the plan assets, then you would have a pension asset. Well, that would mean up here we'd have to have instead of $700,000 here, it would have to be less than our plan assets here, $640,000. Then we would be debiting or increasing our pension plan asset account here. Well, the case was here where our accumulated post-retirement benefit obligation is greater than our plan assets, then you're going to have a pension liability. So you got to follow these guidelines here. So this is the case here where we got the pension liability here. The post-retirement benefit obligation here of $700,000 is greater than our plan assets here, $640,000. So the difference is going to give us a reduction in our post-retirement asset account here of $60,000. Okay, so that's our guideline here. Now we are going to determine what our pension and asset liability is, we have to determine what the end of the year amount is here for the year here, and we're going to determine that to be $151,000, and then we're going to be able to determine what the post-retirement benefit obligation, if we got to have a balancing amount here for the year X1, either it's going to be a debit or a credit. Well, it's going to be a credit here, a reduction to our post-retirement asset account here of $91,000, because we got to come up with the balancing end amount here of $151,000. So how do we get the $151,000? So we go down to our post-retirement benefit obligation here, and we have to compare that to post-retirement plan assets. This is our asset account here. So looking at how do we get down to our end of the year balance here in our post-retirement obligation account. So we started out with that beginning amount here of $700,000. Then we added in that service cost credit, increase our obligation here for the service cost of $90,000. Then we had that interest cost here of $70,000. And then for our example here, we're actually going to have an unexpected loss. We're going to have a change in estimate to our projected benefit obligation here. We're going to increase it here for a liability increase, an actuarial change here of $100,000, and then we're going to have a reduction here due to benefits that are paid out to the post-retirement benefits paid out to the retirees here of $40,000. So our net amount is going to be, end of the year net amount is going to be $920,000 here. Okay, so that's our post-retirement projected benefit here. Now, look, that's the end amount, $920,000. Now look at our post-retirement plan assets here. Well, we started out with $640,000 here at the beginning of the year. Then that a return on our plan assets, remember the actual return was $64,000 here, and then we had cash contribution here to the plan of $105,000, and then we had a reduction here for the credit amount, or reducing our plan assets for the benefits that were paid of $40,000. For our net amount for the year is going to be $769,000. So again, we go back to our guidelines here. We compare our projected benefit obligation of $920,000 to our debit amount, our credit here of $900,000 to our debit amount here in our plan assets of $769,000. So that is going to give us a balance, our credit, a reduction in our post-retirement asset account here of $151,000, because following our guidelines here, accumulated post-retirement benefit obligation here was greater than our plan assets. Then we have a pension liability, or I'm showing a pension liability. Actually, I've used the term here pension liabilities. We would really change that to post-retirement liabilities here. So, but I'm just using it as associating it here with pension accounting. But when you're doing your post-retirement accounting, just slip in the word here, post-retirement asset or liability. So again, we come up with the $920,000 here of accumulated post-benefit obligation here, greater than the plan assets here of $769,000. So you would credit or reduce your post-retirement asset account here by $151,000. Okay, so we've taken care of our determine whether or not we had an asset or a liability for the year here. What amount this $91,000 is what we're going to use for our journal entries. Okay, so let's go back down here for this projected benefit obligation, just to go through it again and understand where we got this actuarial change. This was just an estimate where we determined that we got to add another $100,000 here to the post-retirement benefit obligation here, because through the actuarial estimated. So this is the case where this unexpected loss here, you would credit your projected benefit obligation here by $100,000, and that's going to increase the liability here on this post-retirement benefit obligation, because you have the change in estimate to the post-retirement benefit obligation. So what you would do here, let's go up and look at it. Now we're going to go back to our other comprehensive income gains and losses here, and we can go back here and look at that here. So in this case, we had a change in our estimate of the post-retirement benefit obligation here, and that's where we had the unexpected loss here of $100,000. So we debit or reduce our other comprehensive income here for $100,000. So we net our change here due to the unexpected loss or the increase in our liability to the post-retirement benefit obligation here. We net it with the unexpected gain here on the return of our assets here of credit amount of $20,000. So our net amount for the year here, what we're going to have in our other comprehensive income is $80,000. So netting out our debits and credits, we're going to come up with a reduction here of $80,000 in our other comprehensive income for the gain and loss. And then just say for the beginning of the year, just say we had a zero balance. Remember, this other comprehensive income is an accumulative amount, but let's say we had a zero balance here for the year at the beginning of the year. So at the end of the year, we're going to have $80,000 sitting on our reduction here, debit to our other comprehensive income. Okay, so we've taken care of our other comprehensive income here and also our pension asset and liability account. Now let's go down and let's look at the other, let's go back to this pension asset and liability account here where we had the $91,000 here that we had to determine what it was here for the year here, because knowing we did determine what our beginning balance was and we determined what our ending balance was, so it became a plug here, $91,000 to determine what it was for the year here. But we really have to look at it in terms of our journal, what we are counting here for our other accounts here. So let's look at how we calculate that. So we take our post-retirement expense here of $126,000. That was a debit amount here. And then we had that other comprehensive income loss. The net amount for the year here was debit amount here of $80,000. And then we knew what our funding or our cash was for $105,000. That credit that was a credit here to our cash account, so that reduced our cash by $105,000. And then we had that amortization of our prior service cost here under other comprehensive income, or amortization of the prior service cost of $10,000 here for the pension expense. That was a credit here. So balancing our debits here with the credits, then we're going to determine what the post-retirement liability is for the year here of $91,000. So that had to become a plug. So we cross-referenced our beginning and the end of the year balances that we determined for a post-retirement asset and liability account here, and we cross-checked it with the debits and credits that we're going to have here for our journal entry accounts here. So debits here of $126,000 plus the other comprehensive income, the loss for the year here of $80,000, balances with our credits here for the cash funding here of $105,000, the amortization of the prior service cost for the pension expense of $10,000, and then the $91,000 that we have here for the post-retirement liability or credit here to the post-retirement asset account, or reduction to our post-retirement asset account, or increasing our post-retirement liability here. So that's the cross-reference that we had to make. Okay, so now let's go and let's look at our journal entries here for this example here. So what we would do, and this is what we would have to record for the year here. So what we wouldn't really be dealing with that projected accumulated post-retirement benefit obligation or our plan assets. Those are just memo accounts, but here's where the journal entries come in, and this is what we'd actually be recording. So our post-retirement expense, we would have debited that here for $126,000. Then our other comprehensive income on the loss, we would have had debited that here for $80,000. Now, our credits go to our cash. We would have reduced our cash by $105,000. And then we have that other comprehensive income for the prior service cost. We would have credited that here for $10,000 here. And then we have our post-retirement liability here of $91,000. So there's our debits and credits. Those are the journal entries that we'd make here for this post-retirement problem that we have. So what we did here is let's go back through it here. We went through this example here, and I'm just looking at our post-retirement asset and liability account here. I got everything laid out here, and you could do if you're doing pension accounting, you're going to have the same entries here when you come to asset and liabilities and your expense as you would for the post-retirement. So when you're dealing with post-retirement, you can just follow along the same as you would for pension accounting here to determine your expenses and then any of the other comprehensive income for prior service costs or gains and losses. You do the same for post-retirement as you would do for pension accounting. So that's the only case that I'm making here. So if you're going to reference or cross-reference here, we're trying to determine any post-retirement benefits accounting, you can actually go to pension accounting and look for the same entries that you would make, the same accounts and the same entries that you have to do for expenses, gains and losses, contributions, and so forth. Okay, so that'll summarize our problem.